Have you ever looked at the bond market and just wondered how a tiny little shift in interest rates can suddenly make bond prices swing all over the place? It can feel like this super complicated financial mystery. Well, today we're going to crack that exact puzzle, and we're going to do it using a really powerful shortcut that the pros use all the time.
Okay, so let's just dive right in with a classic question. This is the kind of thing you'd see on a finance exam, or maybe you're just trying to figure out your own investments. Imagine a bond's yield goes up from 7.85% to 8.5%. The big question is, by how much is its price going to change? Now, at first glance, this seems like you'd need a super complicated spreadsheet to figure it out.
But here's the cool part. You don't. There's a much faster way to do this. It's a shortcut that professionals use to get a quick and, honestly, a surprisingly accurate estimate. So let's walk through exactly how to do it together. All right. First things first, let's lay out all the facts. We know the yield is moving from 7.85% up to 8.5%. We also see the bond's term is 7.6 years, but, and this is the key, the most important number for our little shortcut is the duration, which is 5.2 years. Seriously, this one number is the only tool we're going to need to solve this whole puzzle. So what is this number? Anyway, what is this thing that's going to make it all so easy? Well, let's meet our new best friend, duration. You know, when you boil it all down, the idea is actually pretty simple. Duration is just a way to measure how sensitive a bond's price is to changes in interest rates. It's kind of like a riskometer. A bond with a high duration, say 10 years, is going to see its price swing wildly when rates move. But a bond with a low duration, it's going to be way more stable. Okay, so that explains what it is. But what about the how, right? How does this idea of sensitivity actually turn into a number we can use in a calculation? Well, it all comes down to a really simple ratio. So here's the official textbook relationship. Duration is the percent change in the bond's price divided by the percent change in 1 plus its yield. Now, don't let the formula scare you. With just a tiny bit of algebra, we can flip this thing around to solve for the one piece of information we actually care about, the percent change in price. All right, enough with the theory. Let's put this tool to work and actually solve our problem, step by step. Okay, let's break this down. Step 1, we need to figure out the percentage change in what's called the yield factor, which is just 1 plus the yield. So we take the new factor, 1.085, we divide it by the old one, 1.0785, and then subtract 1. That gives us 0.603%. Simple enough. Step 2, we use our rearranged formula. The percent price change equals the duration times that number we just found. And for step 3, we just plug everything in, 5.2 times 0.603%, and that gives us our answer, 3.14%. But wait, hang on, we are not quite done yet. We have the size of the change, 3.14%, but what about the direction? Is the price going up or down? This is where you have to remember the absolute golden rule of the bond market. Yields and prices have an inverse relationship. When interest rates go up, the price of bonds already out there go down. And that means our final answer has to be negative. The bond's price is going to fall by approximately 3.14%. And just like that, with one simple tool and a little bit of logic, we've solved the puzzle. Pretty neat, right? Okay, so that's the math. It's a cool trick. But why does this actually matter? What's the real world so what here? Well, it matters for a few really big reasons. For one, it's an amazing tool for quick risk assessment. You see a bond's duration, and boom, you instantly have a gut feeling for how volatile it's going to be. It's also absolutely crucial for portfolio management, right? It helps investors balance out those high and low duration bonds to manage their overall risk. And yeah, like our source material points out, you absolutely have to know this for finance exams. But really, the biggest thing is it just leads to smarter investing. It gives you the power to understand risk and make better decisions without needing some crazy, complex financial model. So you see, duration isn't just some random number on a screen. It's a super practical tool for understanding risk. We've seen how it works for one single bond, which kind of leaves us with a bigger, more interesting question to chew on. How would you take this exact same logic and apply it to manage the risk of an entire portfolio full of bonds? Something to think about. Thanks for watching.